G'day guys, it's Jamie here, lead educator at Mastering the Market. So today we're going to unpack something that helped me take my trading and investing up to that next level. And it's a psychology lesson, and it's getting rid of that fear of buying a stock at a higher price, okay? Because I'm always concerned, or I used to be concerned about how expensive or cheap a stock was. And I didn't realize that you can actually make more money by buying a stock at a higher price because it's all based around your capital deployment, your stop loss, and how much you're actually going to risk. I'll draw it for you live on one of my trades that I did back in the day on South 32. Let's jump in and have a look. So the first thing that we're going to talk about, it's getting expensive, okay? Oh, I want to buy it because it's getting expensive, $1, $2, $3. You don't think in those terms, okay? Chasing it, I want to buy it, it's getting expensive, that's not the right mentality, all right? Waiting for the pivot, waiting for a new pivot, waiting for another situation to come in, okay? I'll wait for a tighter stop loss to form. That's what you actually want to do. Both traders in both scenarios end up longing the same stock, but only one of them has a stop loss that's actually standing on something real. It's going to dictate to you how much capital you can deploy. Instead of putting in $5,000, you want to put in $10,000, but you're going to need the proper stop loss to do it. Let's dive in and have a look. So the equation we actually do is a position size, which is your shares, which equals your account risk divided by your risk per share, okay? And your risk per share is effectively entry price minus your stop loss, okay? To summarize that, let's have a look at an example account here. At $100,000, you're supposed to be risking 1% per trade. That's $1,000. So your stop loss shouldn't sit under a low from months and months ago just because it's the only one you've got. It should sit under a fresh tested low close to your entry, and that's where you can deploy more capital. Let's go and have a look live at the charts, and I'll show you what I mean on South 32. Okay guys, here we are, South 32 on the daily time frame. Let's have a look. Now, back in 2025, South 32, it started to run. Okay, it started to run pretty hard and everyone wanted to buy and wanted to get a piece of it. Okay, each day that went past, it became more expensive. That's FOMO, and then you start rushing in. But I'm going to show you why I waited and I was able to put more money down in scenario 2 than I was in scenario 1. Well, let's unpack it. Let's pretend as we were moving up here, you rushed in and you went and bought here. Okay, so around these levels, let's mark this up as a entry. Okay, so scenario 1 here, we've got a $100,000 account and the entry price is around that $3.20. Right, that's around this scenario here. Your stop loss is miles away. Okay, so I'm using this as a higher low. All right, it's something I teach in class all the time. These major pivots as they come in, major pivots, major pivots, major pivots. This one here is the higher low. Okay, and that's where our stop loss has to go. So if we look at how far away that is, how far away is that? That's a good 20% away. All right, looking at scenario 1 here, $100,000, buying at $3.20, 20% stop loss, which is that previous high low. All right, that's a risk per share of 64 cents. We're only going to risk, $1,000 worth of capital. 1,562 shares can be purchased. Effectively, when it all comes down to it, if you don't understand those equations, what it means with a 20% stop, we can deploy $5,000 and risk $1,000. Okay, so we're going to risk $1,000 to make $5,000. That's not too bad. You can do it, all right? But as you get better, as you turn more professional, or as you even want to get better at your training, you do not want to have a stop loss this far away. Let's have a look at scenario 2, which is the scenario that I did. Let's let South 32 play out a little bit. Okay, so I'll press our play button here. This is a live chart. It's going, it's going, it's going. Okay, now let's look at scenario 2. That entry will now be moved up to this level here. Okay, and this isn't the previous high or low anymore. Right, it has moved up to here. Okay, this is our new higher low. So that was our higher low. That was a small pivot higher low. This one here is the one I'm looking at because this is where the buyers have stepped in. So now this is my higher low. All right. So now I can run a stop loss around this area here. All right. So previously my stop, like I said, would have been all the way down here, but now it's up nice and tight here. All right. Scenario 2, I paid more for the stock. Okay, $3.20 is what I bought it at before when I had FOMO and I was not knowing what to do. $3.30 is what I'm paying now. Okay, I'm paying more. I'm buying it up here around this new entry price. My stop loss, if we have a look, it's only 8% away. It was about 7 or 8, might have been 7. I was generous. I said it was 8%. Again, this was a real stock. I had to recall a real trade, I should say. I had to recall exactly what I did. 8% away. Now that's much, much better. So the equation changes. Still $100,000, scenario 1, scenario 2. Entry price was $320 when I had FOMO. Now it's $330. But see how much tighter my stop loss is? It's 8%. It was 20%. This is no good. Don't do this. I teach this all the time in my classroom about getting these tight stops. So the equation now, risk per share, okay, is 0.264. Still risking $1,000, the same as scenario 1. I can buy more shares, so I can deploy $12,500. Over here, I was risking $1,000 to deploy $5,000. Over here, I'm risking $1,000 to deploy $12,500. You want to get more capital down, don't you? The difference is how far away these stops are. 20% was no good because it's tighter, it's 8%. And to get that tight stop, I had to wait for the price to move. Okay, I didn't buy over here as it was getting expensive. Okay, it was moving from $2.60, okay, $2.80, $2.90, starting to create that FOMO. Everyone's going to buy, but you'll learn to wait for a new higher low. Okay, down here was no good, up here is better. So my whole risk reward and my capital deployment situation have completely changed, haven't they? So as the stock moves, let's now watch it move. We'll remember scenario 1, but we're actually in scenario 2. Let's let this play. And it did take off. Thank God, I know what I'm doing. And away we go, okay? Now we started to top out around that level. This is where I took profit. And we'll have a look at why I took profit there in a sec, because I know everybody will be curious. Let's have a look at this run. Okay, so from here, this run here, I banked at about 40%. So it went 47%. I actually took profit around 40-ish. I'll be generous because I didn't get the exact top. That's impossible. It was about 40%. So the two scenarios are this. Let's recap. Scenario 1, you put down $5,000. You can do it. There's nothing illegal about that. If you follow the 1% rule, I've laid it all out here for the calculations, you can do that. But at the end of the day, you've made 40% on $5,000. That's all right. Nothing wrong with that, okay? But in the new scenario, okay, the scenario where you've got some education, the scenario where I've taught you what to do in class, you are going to make $40,000 on $12,000, okay? What do you want to do? Do you want to make 40% on 5,000 or do you want to make 40% on 12,000? I know what the answer is going to be. Believe me, I know what I wanted to do back in the day. How do you get these better scenarios? By understanding the pivots, okay, which we teach in class all the time, and understanding how much capital you can deploy through the equations we use, and always risk $1,000. I was never going to lose more than $1,000, which is exactly the same as scenario 1. So what's the summary? I've paid more for a stock than scenario 1 trader, but I've made more. That is how you change the level to the game. That is how you increase your trading capacity. And because I know a lot of questions will come in, we'll just delete all this now and I will show you why I would have taken profit there. This is a video for another time, but we hit that major resistance right there. Okay, so that is where you would take profit like we did. Okay, so let's recap. Let's basically put it down into 3 rules. Okay, first rule, don't just buy because it's getting expensive. Don't do that. That's amateurish. Okay, the feeling means price has already moved, not that your risk is under control. Check the stop loss. Your stop loss will determine everything you do. And people will say, oh, I'm not really a trader, I don't use stop losses. It's exactly the same for investing. All right, take my word for it. Number 2, a fresh tight stop beats the stale wide one. Well, we saw that, didn't we? Okay, so paying more for a stock with a real nearby base beats paying less. In this case, it was that higher low. You want to be close to that stop loss. And number 3, let the base decide your stop. That's what I was talking about, not your entry. Don't worry about what you're paying. Think about your risk reward profile. If the only stop you can find is a long way down, that's a sign to wait, not a reason to size down and hope. Wait. Patience is rewarded in the market, believe me. To finish up there, guys, this is one of my favorite sayings, okay? You need to protect your capital at all costs. Your ticket to the game, if you want to play the game, and everyone wants to make money, okay? Your ticket to the game is your capital. That's it. Lose it and you're out of the game. Think about it. Well, I just showed a 40% trade, a 40% move. You can have all the skills in the world, but making 40% of zero is zero. Okay, you're going to need your capital. The first thing we always teach at Mastering the Markets, how to protect your capital through that risk reward. You could have put $12,000 with that 20% stop in scenario 1. That is a recipe to blow your accounts. How do I know? Because I've seen it time and time again through all our students. Risk reward, deploying the correct amount of capital, that is how you change the levels to the game. See you on the next one.